Hey everyone, welcome to the case study breakdown of the Smiths, two crypto brothers from Australia. So, the Smith brothers from Australia are both planning to move out of Australia and exit the Australian tax system. John and his wife are considering relocating to Thailand, while Mark, who recently secured a new job, intends to start a new life in the UK with his family. Both brothers are involved in the crypto business and have recently established a holding company in the British Virgin Islands and an operational company in the Cayman Islands. John is the majority owner with a 60% stake, while Mark holds 40%. Now, important areas that we need to examine for them and break down are these following questions. Firstly, what were their tax obligations slash tax residencies for the previous year? So, are they still considered a tax resident of Australia? If not, when did they cease to be tax residents in Australia? And also, were they tax residents or have tax obligations in Thailand or the UK where they plan to move to? And secondly, what is the purpose of the two company structure? A, does the structure make sense? And B, what should the ownership be? John and Mark were contemplating 60% for John and 40% for Mark. So we'll break down if this is actually ideal. And then 3, what is the best personal tax and residency status for John and Mark? So John was contemplating the Thailand tax residency. So is this the best option for him? And B, should Mark opt for the non-dom regime in the UK? And fourthly, what is the actual character of the income from the crypto business? So this is extremely important in terms of what you can do in terms of tax planning or residency setups or what you can actually label incomes as. So is it A, earned income since it is derived from work? Or B, is it capital gains since an asset was being purchased and is now being resold? So it's important to understand what is the type of income, no matter just in this business where it's in crypto, but any sort of business that you're dealing with or freelance or agency work, exactly what is the nature of the work or the income that is being derived. So these are some of the important areas overall that we need to examine in this case. So, when considering incorporating a company or relocating to a new jurisdiction, it's crucial to consider various factors together because it's not useful to select a jurisdiction for incorporating a company if it is not crypto friendly or select a jurisdiction to relocate to if there is no actual practical residency program available. So there are around 200 jurisdictions in the world and we can narrow the list down by applying some filters. 1, countries with competitive tax regimes from a company side, and 2, crypto friendly countries, so where banking and regulation become favorable for crypto businesses, and 3, bank accounting options. This is something that a lot of people forget about and they often set up in some random blacklisted island country in the Caribbean and they don't actually think about banking, which is of course extremely important because you need to be actually able to move money in and out of bank accounts effectively. So if you're used to banking in the West or in East Asia and suddenly you're trying to deal with setting up a bank account in some random jurisdiction you're not familiar with poor banking options, then you're going to end up with an actual huge headache. So this is an important third aspect we need to consider. Now, different jurisdictions will have different definitions of residency and ties. Australia, for example, has a broad definition of residency, and many things are actually open to interpretation. So many could actually be considered its tax residence even while abroad. Now, when it comes to the company, one of the most common mistakes people make when considering a global strategy is to confuse the place of registration of a company with the place of residence of a company. For example, they might start looking for a list of countries with 0% tax and think, great, British Virgin Islands, in this case we'll shorten it to BVI, has no taxes. So I'll form a company there and it won't be taxable. Most of the time, this would be wrong. It's true, BVI might not tax you, but this doesn't mean other countries aren't going to tax you. And if they do, what have you actually gained? In fact, a foreign registered company that's tax resident locally is taxed exactly the same as a local company, but with the added hassles of maintenance. So let's say, for example, you're in Spain. Even if you have a company in the Cayman Islands that's having a 0% tax, it will still be taxed as if it were a Spanish located company. But now you just added additional hassles of maintenance of having a foreign company and the accounting abroad, etc. So you actually gained nothing. But once again, each country has its own tax residency rules. So one of the most important factors we're considering is what tax residency rules apply based on your global ties and how to avoid triggering corporate tax residency in high tax countries. So what would we have done if it were fresh? In the case of John and Mark, we're not big fans of the tax haven country where they incorporated their business. If we were to build it fresh, we definitely wouldn't have recommended a holding company and an operating company. Instead, starting with a single company and then adding a parallel company would be a good approach. Given the management and control rules in the UK, we wouldn't recommend Mark to be a shareholder or director in the company at all. Instead, John could consider gifting him for his involvement in the company. So when is a holding company actually useful? A holding company is often useful in cases where you're in a taxable environment and need to be able to move money between companies without triggering tax so they can all be part of the same group. It's also useful for liability purposes. If you want to have an investment company separate from your operating company but can't withdraw dividends without paying taxes. However, in John's case, none of these things are true, so simpler is actually better. All of the benefits that can be achieved with a holding company can be achieved more cleanly and easily by utilizing a parallel company, which is what we'd actually recommend. So why do we want this additional parallel company? The main reason for an additional company is to access different banking and payment processing options, or to keep business separate between what's done between John and Mark and what one of them is doing alone, particularly John. The benefit is it's easier to keep funds earned by John via dividends and have funds gifted to Mark clearly separate. Remember, gifts aren't gifts if they are easily viewed to be earned. It creates a clear separation of liabilities and it makes banking a lot easier. Now, why was their location a bad choice? So we definitely wouldn't have recommended choosing the BVI or the Cayman Islands. Not only are these islands typically blacklisted in many countries, but our main concern here is banking. So some of these islands either don't have banks or have very limited options, and this becomes especially challenging when dealing with crypto businesses, as we need a location with as many banking options as possible. While the idea of having zero tax is appealing, the Cayman Islands are much too expensive without the benefits, given the type of business being operated. And both options make banking difficult. It's important to remember that it's possible to operate purely in crypto for the company. This leaves us with a choice. Either make the most of the current situation and try to make it work, or make a complete change. The easiest options is to keep the BVI company and attempt to use it. Then, if a new add-on company comes up, don't use the Cayman Islands. Instead, consider using countries like Cyprus, Georgia, a US LLC, Labuan, or Hong Kong, depending on the specific needs. If we want to keep the current business intact, then we'll keep the BVI company and see what's possible with banking, but we'll transfer it into the name of John instead of Mark. This is because Mark will be fully exposed to the UK management and control rules, plus likely CFC and likely PE rules, meaning Mark would still be fully taxed by the UK anyways, so there's no point. So what other locations should they use for new add-on companies? There are several options that we would recommend instead. So first up is Cyprus. Being an EU company will give far superior access to crypto-friendly banking, and it's possible to be a non-resident in Cyprus for tax purposes, potentially resulting in zero tax and various banking options in the EU, which are dramatically better compared to the Caribbean. Then we've got the Georgia virtual zone. So the virtual zone is for IT businesses. And this would seemingly fit well with what John and Mark do, including also web design and also crypto forensics. So it will be possible to operate through a local company with local banking and extremely low tax, or even tax-free, if they can obtain a free zone company account. Next up, we got Labuan or Hong Kong. So Labuan would give access to numerous Singapore banking options and a strong network of tax treaties. It's not quite zero tax, and it requires local substance, but especially if Mark is also going to be a shareholder, there are strong advantages to this. The substance increases the cost, but also comes in the form of resources which can be used for the business. Similarly to this, Hong Kong is also a possible option and fulfills pretty much the same aspects. Then finally, we've got the USA, so specifically opening an LLC in the US as a pass-through company. The only concern here would be the banking. The banks that we typically work with and that allow you to open a bank account remotely are not crypto friendly. The situation is different if you're willing to travel to the USA to actually open the bank account. So that's what we would have to say when we would think about new add-on companies. Now moving on, what's the best compensation structure for the two then? So how are they going to funnel money and split the profits between the two? So, as mentioned before, it is not good for Mark to be the owner and director of the company, given he intends to relocate to the UK, or in general a country with management and control rules, as well as other factors that negate all the tax benefits. So he should ideally be entirely removed from the BVI company and replaced completely with just John. This will greatly reduce the risk to the taxability of that company. So with this setup, John can gift his money to Mark, and he also intends to gift money to his family in Australia. These type of gifts would not incur any taxes on the Thai side, as Thailand only taxes resident recipients, and this arrangement would also be beneficial for Mark and his family in the UK, as cash gifts are not considered income by the HMRC and thus are not subject to income tax. So in conclusion, the overall strategy is as follows. Number 1, exit Australia's tax system and avoid tax residency there, so cutting as many ties there as possible. 2, establish a new residency for both John and Mark, so in this case relocating to Thailand and the UK. 3, establish the new legal structure, so creating that additional parallel company. And 4, set up banking to operationalize the plan. And then finally, In step 5, earn profit for John, which he'll take out as dividends, and separately send gifts to Mark. As an additional bonus for Mark, we also had him apply for the non-dom status in the UK, because even if he doesn't use it immediately, it's better to have it as an option than not. So what's the benefit of this whole shift? The advantages of the strategy are substantial. So let's talk about the original state first. If the Smiths were to proceed with the original plan, which involves having a holding company in the BVI and the company in the Cayman Islands, while residing in Thailand and the UK, the resulting outcome would be as follows. If the company in the Cayman Islands has a $500,000 profit at the end of the tax year, it will not pay any taxes in the Cayman Islands or when distributing income to a holding company in the British Virgin Islands. Seems fine, right? And the tax situation in Thailand will also be favorable. But the issue here arises on the UK tax side. So if Mark is residing in the UK, the BVI company will be subject to UK management and control rules and CFC rules, leading to taxation by the UK at a rate of 25%. This means that on a $500,000 profit, the UK tax will amount to $125,000, which is a large amount, right? So let's talk about the new state that they're now in. So our new structure led to a completely different outcome. By keeping the BVI company and adding another parallel company, we can maintain a clear separation between the business done by John and Mark and what John does on his own. This will ensure that the funds earned by John through dividends and the funds gifted to Mark remain distinctly separate. Additionally, this approach will provide access to different banking and payment processing options. The most significant change comes from removing Mark as a shareholder and director of the companies and paying him his part as a gift. This would help avoid UK taxation and result in being taxed at a rate of 0. So instead of paying that $125,000 a year in taxes, you will end up with 0. Over a 10-year period, this approach results in savings of $1.25 million. And that's just purely if you were to save it into a bank account and you don't do anything with it. If you were to have taken that money and continually invest it over the 10 years, you would have way more. Now, the cost of setting up this structure was not high at all. We only needed to change the shareholders and the directors of the BVI company and incorporate an additional parallel company. So the overall cost should not exceed around $6,000. So just a quick recap on everything in case you might be lost. The overall strategy is as follows. Exit Australia's tax system and avoid tax residency there. 2. Establish a new residency for both John and Mark. 3. Establish the new legal structure. 4. Set up banking to operationalize the plan. And 5. Earn profit for John and send gifts to Mark. So in summary, the whole benefit of this plan results in a $6,000 investment cost to achieve $1.25 million in savings over 10 years, or on a yearly basis, $125,000. So this was a dramatic shift for them and allowed them to save a lot more and invest into either other business ventures or for their family or for their personal lifestyle in general. And this is an example of controlling where your money goes with smart legal planning as an entrepreneur. Thanks for watching this breakdown video. We hope this was informative in showing you how we like to think and how we like to go about things. Feel free to keep scrolling and look at our other case studies. Elsewise, if you want to make the jump for your own journey, make sure to book a call and start the journey with us. Bye bye now.